Morning, going well. How are you?
Yeah, very good for a Friday, mate. Interesting week in the market. We've had a couple of fairly solid falls, and then a little bit of a sort of push back up each of those days.
It has, yeah, and strong move up in the US markets last night, and a solid bounce back in a few commodities. I think copper was up over 2%, gold was up over 1%, and the GDX gold miners ETF was up over 3%. So commodities could be a bit hot today.
Yeah, certainly that copper move should be pretty big support for both BHP and Rio. Rio was under a lot of pressure yesterday, breaking under 160, so I'd probably expect to rally back over that level today.
Yeah, definitely.
Right, well, let's get into a couple of the ideas we had for this week. A few stocks really do look a little bit stretched, so a couple of covered calls that we were going to suggest.
Yep, you want to jump into Woolies there? I'll just bring
Yeah, that'd be great.
Woolworths up for you.
Yeah, so looking at Woolworths, look, the stock's had a really big run over the last sort of 6, 8 months, pushing up from around the $30 mark to over $40 at the moment. Where I suppose when we start to analyse stocks, it's trading at 29 times its forward earnings. So its price to earnings is 29 times. This stock normally trades around 20 times its future earnings. So really very expensive versus historical trading averages for the company. And I think breaking that above that $40 level to me really makes it look very stretched. So I was sort of looking at the idea of maybe for those that own the stock, looking to sell some covered calls out into August.
Yeah, I think that's a pretty good idea, H. And I think you got to look at Woolworths and why you're buying it at the moment. And if it's on a yield basis, a tick over 2% probably isn't really stacking up.
Yeah, very true. And I think, look, we sort of talk about it has been that buying for that defensiveness that Woolies has seen as being, the sort of shopping centre or the supermarket type business. At that yield level, the defensiveness is probably not really that attractive anymore. I think we'd normally have said, well, we should switch out of Woolies and into maybe Coles, but it looks like Coles is just as stretched as Woolies. So you'd sort of say that whole sort of sector of the market looks very overpriced. So for me, I was starting to look around at other stocks that we could, for those that own either Woolies or Coles, could switch into. And one that did jump out at me would be probably Telstra, which has had a pretty terrible week in the media with a few outages. But as a defensive stock, it is definitely a very good play for investors, and it does yield over 4%. So a little bit better yield than Woolies and Coles. And I think with the stock under $5, probably some reasonable value. Most of the research targets to me look to be around 5.30 or above. So that'd be a good switch if you want to get out of Woolies altogether. If you want to just look at writing that covered call, a $41 call for August, we're looking at premiums around 60 cents. So if you own the shares, I think that'd be a really smart move.
Yeah, just on Woolies as well. I think Jeffrey's had a good note out on it earlier this week, talking about how supermarkets usually benefit from the inflation in food prices. But
Yep.
I think it's going to be harder and harder to do that with the cost of living crisis at the moment. And then just there's so much scrutiny on our big supermarkets as well. So I don't think that'll flow through like it normally would. The
Yeah.
other thing
Okay.
I'll just flick through, H, is our new seasonality tool in our advisor portal,
Yep.
just to show you how Woolworths is typically traded um, month to month. So July is typically strong, up 2.4%, and then it really rolls off flat month in August, and then down in September as well. So that probably supports your trade idea there.
Yeah, excellent. Yeah, I think anyone who owns a stock, if you're not looking to sell some calls up here, you're probably taking a lot more risk than you realise, because there's probably easily $3 or $4 of heat in that Woolies stock that could come out quite quickly, especially if the results don't show any real change to their profits, which I don't think they're likely to show any real movement any more than 1 or 2% of growth. I just don't think it's there for that sector.
Yeah, and what's already priced in, right? So.
Yeah, definitely. Definitely. So, yeah, Woolies selling a covered call for those that own the stock, or a switch out of Woolies and or Coles into maybe Telstra is the idea for our supermarket sector. And what did you have to look at, mate?
Mate, I had a little idea in QBE. It's a covered call. The idea is basically flagged from the update Suncorp provided last week. They flagged a few things with their earnings, higher reinsurance costs, higher hazard costs, and then they actually flagged a big drop in the earnings on their mark to market of their bonds, which is actually quite rare to see. But it's marked their investment earnings down about 35% this financial year. So Suncorp actually got whacked on the back of it. And I'm seeing a fair bit of divergence in the price of QBE, which hasn't updated the market at all yet. So I think if you own the stock, it's had an incredible run over the last little period here. If you can sell some covered calls around $27, I think they're around 40 or 50 cents. So you're getting around that 2% earn on that call. I think it's probably showing the first crack in the insurance market. So I think that's a pretty solid one there.
Yeah, I definitely agree with that. I think it looks pretty stretched. I did have a look at some of the valuations for QBE. I think Macquarie downgraded it recently to 23.90. I think that was 2 days ago, that research report. So they're definitely seeing a little bit of a reason to pull back in the price. So I think that's a really good one to look at selling there. So you're thinking an August call?
Yeah, August 27's I like.
Yep.
But yeah, you'd see how it traded today and get your entry there.
Yeah, fantastic. Okay, I think that's a great one. The last one, I suppose, the idea we're going to talk about was just the oil sector in general. Obviously, lots of movement in the oil price with tensions reigniting in the Middle East this week. We did some analysis, and really we were comparing the oil futures versus physical delivery oil, and it seems to be there's quite a difference in price. So physical delivery is actually trading at a big premium to oil futures. I think that's very interesting. Obviously the futures a lot more speculation in that market, where not many people are taking physical delivery of oil, or those that are obviously the real consumers. And obviously if they're paying quite a premium to the futures, it's quite an interesting scenario.
Yeah, it is. And then you compare that to Woodside and Santos and what percentage of oil they've already sold, I guess, and how much they can actually benefit from this.
Yep.
But it's a really interesting dynamic, and I guess it just comes from so much demand for having oil now, and especially around Asia, where our government included has probably contributed to some of this with bidding up oil and just wanting it now to reassure their population. So yeah, it'd be interesting to watch.
Yeah, I think something also to be wary of. I think the US, obviously that big strategic reserve they've got, there is a limit of how much they can draw down from that to sell off internationally before they've got to sort of reduce the international sales and keep what supply they have for their own consumption. I think might be 300 million barrels or something, but there is a limit that they have of how much they can draw that down to. So if we get close to that limit, that could be quite interesting for oil, because the refineries in the Middle East are just not going to come back online. Many of them were totally destroyed. They're 2 to 3 year rebuilds in many cases. And obviously, if we've got more issues with shipping coming through the strait there, that's going to create fear again. So I think Woodside is an interesting one to look at if you can get into the stock at current levels or maybe a little lower. I think it's worth having some exposure to, just in case this whole oil mess sort of jumps up again.
Yeah, I agree. And you're going to have a bid for a long time as countries around the world want to build up their reserves, like you mentioned. So
yeah, that'll be the new play, won't it? Building reserves will be the new thing. But if you just haven't got refineries to bring that oil flow into usable barrels, it's going to be quite a delay until that's working. So I think we'll have a real lag on when we actually can, even if shipping opens, when we can actually get the physical barrels moving.
Yeah, I agree.
Righto, mate. Well, it's interesting Friday. We're a bit of a positive lead from the US, so we'll see how our market tracks today.
All right. Thank you.
All right. Talk to you next week. See you, mate.
Bye.
All good, mate. Stopped it.